Hello, welcome back to Author's Note. Now, Turkey saw quite a run-up in its asset prices last year on a wave of optimism about the economy's performance, but it struggled to keep up the momentum so far in 2013, in spite of some improvement in Turkey's perennial problem for investors, which is its very large current account deficit. Here to discuss with me what's going on is Timothy Ash, Head of Emerging Markets ex-Africa Research at Standard Bank. Timothy, thanks very much for joining us. We've got a couple of charts to look at. The first one shows us what's happened to that current account balance. It has been getting steadily worse for several years, understandably reduced during the financial crisis and then went on down its downward spiral. Now it looks like it's getting better. What's going on there?
Well, I think certainly in 2011 and the early part of 2012, the economy was overheating.
Right. And
the central bank essentially put the brakes on in early 2012, and we've seen rebalancing. So domestic demand slowed through 2012. There's a bit of a pickup in exports as well, and that narrowed the current account deficit. Now, I would also point out that a large part of that improvement relates to one-offs. There was a remarkable increase in gold exports in Turkey. It doesn't produce gold, but
right.
The implication, I think, is that those were exports to Iran. It was about $10–11 billion turnaround.
Right.
So around 1/3 of this improvement is gold related, which
so that's over. That's not going to happen.
Well, that's
again.
unlikely to go through into 2013 because tightening of sanctions
right.
regime against Iran, I think.
Right, but nevertheless, with some improvement, investors should be cheered up, shouldn't they?
Well, I think there's recognition that in 2013 the economy growth will improve a little bit, and certainly that's the message from the central bank.
Right.
I think perhaps the underlying problems in Turkey in terms of the current account are still there. Huge energy dependence, around 55 billion energy imports into Turkey annually. And as growth rebounds, I think the assumption is that the current account re-widens again, probably not to where we were in 2011, remember a 10% of GDP current account deficit,
right.
But I think it's quite likely we could go back up to 7–8% of GDP. That's very possible.
Okay, and is the Turkish government prepared to cover that? Does it have the financing in place?
Well, as you know, it's not just about a current account deficit, it's how you finance it that's important. And I mean, the key problem I think for Turkey at the moment is hot money financing of the current account has increased really significantly over the last year.
Right.
To put that in perspective, if you think the previous record high in terms of net portfolio inflows was around $20 billion in 2011. It was around $40 billion in 2012.
Right.
That's about 5% of GDP. So the bulk of the current account is being funded by hot money.
And that obviously can go away as quickly as it's come in.
Absolutely. I mean, when it leaves, it can have a very big impact, particularly on the currency.
And what about foreign direct investment then? Is that on the way down?
Well, unfortunately, I mean, through the global financial crisis, emerging Europe saw a collapse of FDI flows across the whole region, about half the level. Now, Turkey has always had a good growth story. It began to recover net FDI in 2011, came in around $13 billion net. But actually, interestingly, in 2012, it also dropped quite
right.
significantly. It was back to about just over $8 billion, so quite disappointing.
And is that nervousness about Turkey or about broader?
Well, I think there's an underlying story that investors don't want to be in Europe, full stop, even though Turkey has a very different kind of growth story. And maybe in Turkey in particular, I think in 2012 there were still concerns about the exchange rate story early in the year. Remember, Turkey was facing a mini exchange rate crisis
right.
in late early 2012. So I think that possibly delayed things. There's also been a slowing in the rate of privatizations in recent weeks. There's been new news on that in terms of delays in energy and infrastructure investment, FDI, and privatization.
Right. Timothy, thanks very much indeed. So plenty to watch in Turkey, things improving on one side, but as with so many emerging markets, a lot of factors beyond Turkey's control to keep a look out for. Plenty more on this on ft.com and on our emerging markets blog, Beyond Brics.